By July 2026, ship traffic through the Strait of Hormuz had fallen to just 41 vessels a day, down from roughly 130 before the war, a decline of nearly 70%. That single choke point normally carries close to a fifth of the world's oil and a quarter of its seaborne trade. The war that closed it was supposed to last days. Instead, it has reshaped inflation, growth, and military budgets on every continent. It is proof of a pattern that has repeated for more than a century. A war that starts small rarely stays contained, because the economy is the fuse that carries it everywhere else. The public narrative treats wars like this one as regional and bounded. The data says otherwise. The IMF's July 2026 outlook revised global inflation upward for a third consecutive time, to 4.7%. This came largely because of this single conflict. The Middle East and North Africa region alone faces a growth downgrade of nearly 3 percentage points. Global military spending, meanwhile, already hit a record $2.887 trillion in 2025. Before this war's full second-order effects even reach next year's defense budgets. The mechanism is not new. In July 1914, a single assassination in Sarajevo triggered a cascade that closed nearly every major stock exchange in the world within 5 weeks. Treasury Secretary William McAdoo shut the New York Stock Exchange for 4 months to stop the bleeding. The London Stock Exchange stayed closed for 5. Nobody in Sarajevo intended to crash global finance. The financial system did that on its own. 59 years later, a different war proved the same principle through a different channel: energy. When Egypt and Syria attacked Israel on October 6, 1973, the Yom Kippur War lasted less than 3 weeks. The economic shockwave lasted years. Arab members of OPEC embargoed oil exports to the United States and its allies, and the price of crude nearly quadrupled, from $2.90 to $11.65 a barrel by January 1974. Inflation and unemployment rose together, a combination economists had assumed was impossible. Both episodes share a structure: a regional trigger, a choke point, and a transmission mechanism that turns a local shock into a global one. That structure is not just historical. Global defense spending has grown 41% over the past decade, and NATO's European members posted their fastest one-year military spending increase since 1953. Nations do not build that kind of arsenal in a vacuum. That expectation is being tested in real time. Operation Epic Fury began on February 28, 2026, when United States and Israeli strikes killed Iran's supreme leader in the opening hour. Iran retaliated within hours, launching missiles and drones and restricting traffic through the Strait of Hormuz. The transmission to the wider economy followed the same playbook as 1973. United States gas prices climbed above $4 a gallon within 8 weeks. The IMF's April 2026 outlook cut the Middle East and North Africa region's growth forecast by 2.8 percentage points to 1.1%, and projected a 6.1% contraction for Iran's own economy. By July, the IMF's global headline inflation forecast had been revised up to 4.7% for the year. Citadel's Ken Griffin told a Washington audience in April that a 6 to 12-month closure of the strait would make a global recession unavoidable. United Nations Secretary General Antonio Guterres warned that even a full and immediate reopening would still cost the world 0.3 of a percentage point of growth this year, with supply chains needing months to recover. The damage did not stay confined to oil. Fertilizer and LNG shipments out of the Gulf were disrupted alongside crude. Airlines across Europe canceled thousands of flights over jet fuel costs. The Philippines declared an energy emergency. Pakistan closed schools for 2 weeks to conserve fuel. None of these countries were combatants. The war has also fed the arms race that preceded it. The United States Congress approved more than $1 trillion in defense spending for 2026, a signal that this conflict is being absorbed into the baseline assumptions of governments planning their next decade of budgets. For a household in Ohio or a shipping firm in Rotterdam, this is what a distant war now looks like in practice. Higher prices at the pump, higher prices at the grocery store, and a central bank less able to cut interest rates because inflation refuses to fall. The next test of that principle may already be forming. Analysts tracking the Taiwan Strait describe rising, not falling, risk through 2026, driven by pressure inside China's military leadership and Beijing's approaching 2027 readiness target. Most assessments still consider a full invasion unlikely in the near term. But Taiwan produces the advanced semiconductors much of the global technology industry depends on. If the mechanism that turned a war over Iran's nuclear program into a global inflation shock repeats there, the transmission channel would not be oil. It would be the chips inside nearly every car, phone, and server on Earth. The size of a war has stopped predicting the size of its economic consequences. What matters now is whether the war touches a choke point the rest of the world depends on. In 1914, that choke point was global finance. In 1973 and again in 2026, it was oil. The next one may be silicon. 50 years from now, will 2026 be remembered the way 1973 is, as the year a regional war rewired the global economy? Based on the data so far, that verdict may already be written.